Hey, what's going on, traders? Hope you guys are well today. I thought I would make a little video doing a bit of a recap from today's session, or I just wanted to basically discuss a few things that I thought were pretty relevant to today's session, things that could potentially help out some newer traders without going into 1,000 details of every little nuance that I look at, but also just kind of try to give a round picture of like what I've been up to and like how I'm seeing the markets these days and whatnot. So if you enjoy this content, guys, smash the like button. It really helps the YouTube channel. Let's get it. Hey guys, so before I do that little recap that I was talking about, I just wanted to actually talk about a couple of things that were more related to things that have been on my mind lately in regards to my trading and whatnot. And we can hear a cicada bug in the background that's buzzing away. I hope you guys don't mind that. If you look at the context of this market, I stopped trading, and as soon as it was starting to do this, every time it would go for a rally, it would pull back in and go for these slow rallies and then pull back in, basically. Certain type of market condition, kind of interesting in a way. What I wanted to discuss is really 2 points that I've been thinking about in regards to my own trading, something that was brought to my attention most recently, and I guess over time of doing this you kind of get used to certain things. So a lot of people talk about the day trading lifestyle, and there's one really good video from Optimus Futures, you should go watch it, where he talks about the day trading lifestyle and various components that are involved in that, and how it's important for you to remain in an optimal state, a balanced state, in order for you to read these markets and manage your risk on a daily basis, and not let the stress of trading and the stress of looking at the markets really slowly eat away at you. Because if you're not really being conscious, it is going to slowly eat away at you, and you're going to end up at the end of the week, you're going to feel like a deflated balloon. And then by the time you get there Monday morning, you probably didn't have enough time to actually recover from that anyways. A couple of things that have helped me. Number one, I stopped drinking coffee in the morning. And for whatever reason, it's been greatly benefiting my ability to just remain calm while trading in the morning and just be very relaxed. And I'm not excited to trade in the morning. I just show up and I look at what's happening. I look at the context. I look at how it's moving when the market opens. And I try to adapt a trading method to whatever it is doing right now, in a way that I can manage my trade based on what it's doing right now. And I'm not excited for it. I'm not hyper about it. And what I noticed is that when I was drinking coffee, I don't know if it was the coffee or anything else, because it could be anything else in your diet too, but I was experiencing some moments where my heart rate would increase and I was not able to really control it. I haven't felt this the last 3 trading sessions, and I haven't drank any coffee before trading for the last 3 trading sessions. So it makes sense that I'm making that connection there, although I don't know if it's the coffee. Maybe I've just reached a more mature area in my trading where I'm not excited for it, and I'm just kind of patiently waiting to see the right things occur. The next thing actually does relate to lifestyle. This is something that I've learned from many months of trading. And by no means am I saying I've mastered this. This is something that's always ongoing. And really what it is, it's the amount of baggage you have in your mind and on your shoulders before you come to trade the market. In the sense that how many other things are on your mind that you're thinking about that you have to get done by the end of the day, or issues that happened the other day, or anything. It really could be even the most minuscule thing that you forgot to do. That alone can hinder your decision-making process. And what I've learned is that I just stopped saying yes to a lot of things in life. Like when people ask you to do certain favors, or when it comes time to getting involved with certain things in life, certain activities, a lot of times it's going to be up to you to learn what to accept as a responsibility and when to say, listen, this is not ideal for me right now. I think it would just be an extra burden on my shoulders, and it's not going to positively impact my headspace right now. So really keeping the amount of things on your mind to a minimal. That's something that I can say is beneficial. You want to have a clear mind. It helps to do some meditations throughout the day that can help you to clear your mind, and it's easier said than done, and it's going to differ for everybody, especially if you're involved in a lot of extracurricular activities that require you in a way to get swept into the moment of what you're doing. So I'm a musician, I play guitar in a band, and when we play, it's really active. You get swept into the moment in a way that's very satisfying. There's a lot of energy going around, and this energy is good in some way, but you also need to learn how to control that. Okay, so that's one example I can give. is that I've been in a place the previous day where there's been a lot of people and I spoke to a lot of different people. I had a lot of different interactions. I have residue from those interactions that are still in me, and my decision-making process may be hindered because of that, believe it or not. I don't know how to give a really super detailed example of that, but what I could say is that whatever you did the previous day does impact you the next day to a certain extent. It's like when you jump into a water of chlorine, if you don't take a shower, the chlorine is still on you. This happens with interactions you have with people. I have a friend of mine who was kind of asking me to help him sell a few items, extra things he had around the house. And part of this process was having me take some of the items and bring them into my place. Now, I have a problem with this recently because I realized that every item that's in my apartment that's just sitting here doing nothing, waiting to be taken care of, what that is, it's just another thing that's waiting to be taken care of. It's another thing that I need to think about that is taking me away from my focus of right now. So again, I'm just going to conclude that with keeping the amount of stuff on your mind to a minimum, keeping your responsibilities to a bare minimum of do what you have to do. Don't accept too many responsibilities that are not relevant to what you're focusing on. All right, guys, I hope that helped somebody out there. So basically this morning, the S&P futures as well as the NASDAQ futures were opening up within the prior day's range. And for me, a rule that's something I've learned over time is that generally when the market's opening in the prior day range, I tend to wait a little off the open. I don't rush in and start buying breakouts or whatever. I just kind of chill out and wait about 10-15 minutes to see what's going to happen off the open. Okay, the only market that wasn't doing that was opening up basically near the closing range of the prior day was the Russell 2000. So I was keeping my eye on the Russell this morning. What was interesting is we had this kind of drop off the open very aggressively, basically pulled all the liquidity and then slowly started to rally its way back up after that. And you know, I was watching the Russell. I've been trying to get more familiar with it, and the Russell, I noticed, is a little bit tricky in the sense that the volume is not nearly anywhere close to what it is on the NASDAQ. And it seems as though the only real time you can trade it seems to be off of the open if you're looking to trade in medium volume conditions. And again, I could be wrong. I want to talk with guys who specialize in trading the Russell, to be honest. There's lots of little nuances with this market, and the bids and offers get pulled very quickly. So in my opinion, if you do scalp on the Russell, you need a way of seeing when the bids and asks are being pulled in one direction, because that can give you a quick indication of where traders are supporting the price and where traders are choosing to not support the price. You see what I'm saying? So little things like that can help you to stay out of trouble. But again, I notice it's very thin. It pulls around a lot. There's good liquidity on the micros of the Russell, but even with that, sometimes you need to be very cautious with how you trade it. So one thing in today's session I wanted to point out was, the first one was actually this. So you see this type of price action here. Look at these bars, and I love range bars simply for this reason, because they allow you to kind of zone in on the actual rotations of the market, like how many times is the market pulling back before it moves, or how many times is the market rotating through an area. And this right here, this type of price action, we saw it a little bit on the NASDAQ yesterday, but I call this, I don't know what to call this, but this is basically, I call it dangerous price action. You don't want to be getting stuck in this type of noise. And if you do see yourself getting stuck and you're looking at the price action and you're seeing this, really it's just an indication that you need to just chill out and wait around a little longer, because action that will get a lot of traders to try and bet against the market, because there's a lot of these pullbacks. It will shake a lot of long traders out of the market as it's pretty much doing nothing and it's taking forever to move, right? And meanwhile, it's slowly getting bid up, but ever so slowly. So here's me trying to get on a little short trade. And basically I was playing the range here. So I was watching 30.5 up to about 31.7, maximum 32 offer. And I can see all this liquidity that kind of got stuck up here. And so I jumped on this little fade trade. And let's look at how it plays out. So you can see how that 32 offer is still in play. But what I do want to continue to see is 32 offers trade and the bids pull away. And that's a nuance I always look for. So there we go. We start to see the bids pull away. And again, but look at how tricky this is. We got the bids pull down, and then it'll pull right back up pretty soon. So it's almost like the spread is 2 ticks, but really it's more like 5 ticks in the way it's being pulled and manipulated. So you're going to see my scalp order get filled here pretty soon. And what happens after that is interesting, and this relates to, I guess, trade management and scalping. So even just watch how it's trading here, and as long as it's not bid at 32 on an uptick, I'm good in this trade, in my opinion. So there we go, it trades offer, doesn't hold bid. Sellers take it down right away, and again, it's taking a bit too much time to chop, but no red flags. And at this point, it goes through, fills my order there to scalp out a contract, goes down 30 bid, doesn't trade my second profit order, and you saw how quickly those bids pulled. And look at these orders right here. And again, this is why every market is a little bit different, because the liquidity can be drastically different from market to market. Like, look at these contracts right here. You had about a minus 100, and all of that is these guys right here, and then the market's bid against it right away. So what that tells me is that these traders really got trapped right there, and now the market is in a bit of a tricky spot, because we tested through this liquidity pool right here, and now the market is going back up to where it had previously traded volume at 32. So that's why I'm in a bit of a dangerous spot at this point. So how this trade plays out here is how I decide to manage it going forward. So what you're going to continue to see is, look at how the market trades after trading volume on the bid right here in the current trades column. So we had 31 bid, 30 and 8 on an uptick. Whoops. Going down again to test that 30 even. Some decent selling there, 30 and 4. Kind of chopping. And again, bid 30 and 5 on an uptick. Offers pull again all the way back up. Now we see a bit of trading here. 31-1, 31 even, and 5. And you can see how thin it is. This is the problem I have with the Russell. I just need to get used to looking at it a little bit more. But the volume is just kind of light. It's kind of bid now. And now look at how the offers just pull right there. So on average, you see 20, 30 contracts at each price. But look at that volume. 2, 5, 2, 7 contracts. What that tells me is that the offers were just pulled right there. So as soon as I start to see offers getting pulled above 232 and we're seeing bid volume also, it's kind of a red flag to get out. So I'm not sure if I take a full stop here or if I decide to scratch it. There we go, 32 and 5, and I actually end up getting the fill for a scratch, which was less than my stop, which is a good thing. You want to get used to doing that if you're scalping. All right, let's move on to another point in this session, which I found is an interesting nuance that I think could keep traders out of trouble. And let me see if I could find exactly where this was. It was right here in this range. So again, I always like to look at the range chart because this is a great way to display the actual price action that occurred, and also having a volume profile next to it kind of helps to see where the trading is occurring as well. So just to get an idea, so we're coming off of a rotation down. Now we're in this range where the market was offered around 74, came down, traded a lower extension, rebid around 68. You can see how we sold off, took it out by about 3 points, rebid the area, still bid around 68. Now when it comes back up, it overshoots the area, and then re-enters the area. And again, on another rotation, comes down right to this 68 to 66 area, trades it on a bid, holds it to the tick, and now re-enters this 74 area. So this is an example of a market right here where you really don't want to be looking to actively, aggressively trade it. So again, this is just a quick way of filtering out if you should be looking to trade it aggressively or not. And again, I do have other charts on my other screen which can help with this as well, just to give yourself a bit of an idea of the context, a 1 minute chart, 5 minute, or a 15-minute chart. Whatever you can use that can help you to identify if the market is in a tradable location. So again, when I see a market rotating like this a lot, and it's basically in this range, in my opinion, there's no point in buying a breakout if it's coming above 74, because what you can see from this chart is that there have already been buyers that have been trapped in this 75, 76 area, and there have already been sellers that have been trapped in this 66 area. So I would not even look to trade it either direction because of what's been happening. We've been seeing traders sell low, and we've been seeing traders buy high, and both of them were wrong. So I would say the best thing to do in this scenario is just simply to wait for one side of the market to get tested and then watch what happens. So as you can see here, there was a lot of chop. It really got coiled up, traded 75. If you did take this on a breakout, you would have got trapped there as it just pulled back to that 70 even bid really quickly. Now we're at 70 even bid. I was watching the Russell. This was an interesting movement. We basically had a blow off top there. I'm just going to skip by that. And then the NASDAQ finally decided to take out the lows. And at this point, in my opinion, when you see one side of the market get tested or accepted is when the volatility starts to open up again, and the opportunity therefore will open up as well. So let's see how I traded this. So as the market is rallying up to the 67, 68 area, I actually decided to get on with some of this momentum. I know I didn't show you the prior setup there, but what I did see right away as I got into this trade, I saw that quick 2-point pullback against me. I knew right away that my price is a little bit iffy. And also you see this right here on the Delta 200, all these little micro contracts here, buyers getting trapped in the 75s area. I know right away that I might be in a tricky spot right here. So I'm willing to give this a couple of seconds, maybe get out on this offer up here. If not, I'm gonna scratch it. So I've got a little scalp contract, and the way it's moving up here seems pretty ideal for my order to fill. What ends up happening is I actually trail a little stop there because I don't want to get stuck in this, and I think it takes me out here on a stop. Yeah, it does. It actually does. The way it was trading there, it was kind of a make it or break it type of trade, so I would say that was a good scratch. And sooner or later it did continue, but we did see a lot of this type of activity today where the market was pulling back to stop out weak hands before it would go for a move. And this is very typical movement of NASDAQ when it's in more of a rotational environment. And again, it's just up to you as a trader to see this when it's happening and adapt your trading to that, okay? Where traders mess up is where they get used to trading a previous condition from a prior day or prior week, and then they try and trade the market like that now, and they end up getting burned because the market you're in now is something totally different. So I'm really a fan of just reading the real time, giving yourself indicators that can help you to understand what the market is doing right now, not what it has been doing or what has been working. So there's another sort of fade trade that worked pretty well here. I'm not going to really go over it because I know exactly what it was. The next and last thing I wanted to cover in this video was simply this right here. So there's actually kind of an interesting pattern that occurred here, and some of you guys who study into auction market theory, you might enjoy this. I see this pattern occur a lot. So look at this trading range, again referring to the range chart because it's very clear to see the actual rotations. So we have this trading range here where our high volume notice somewhere around this 49 area, and you can see there's been a few rotations. We took out the high, rejected it, now went for a new low and re-entered the range. So logically it makes sense to think that once the market has re-entered the range after breaking it on one side, it tends to give a little bit of chances to the opposite side of the range to get tested, right? So that's an auction market theory thing that says if one side of the range gets tested and rejected, there's a good chance it's going to come right back to the center, and there's also a chance it's going to test the other side completely. But there are exceptions. Now let me show you, because this is a bit of an exception to that. So if you look at the structure of this market, and you can look at it on a 1-minute chart or as well as this type of chart, if you looked at the volume, you can pretty much identify that every time the market came up to trade this 49, 50 even to 52 offer, it didn't really trade a lot of volume there. These were considered unfair highs, areas where traders were getting stopped out of short trades, or really late buyers were trying to buy into a breakout, and then they would get kind of stopped as the market pulled back into where it was previously trading. So everything up here was previously considered unfair highs. So in order for the market to actually go above this area, it would need to slowly start to accept more trade in that area. And what you can see is that every time it did trade into this area, it traded there in a way where it never really held the bid and accepted much trade there. So you get a lot of these fake moves, right? So we have a move up here to 52 offer, then it slowly starts to fade. Sooner or later, we're back to 45. Now we get another move. Comes up again, looks like it's about to go for a breakout, 52, 51 offer, fades again. So all the market is looking for is enough liquidity for its next move. In this case, it looked as if it was tricking a lot of buyers into buying in this zone, buying high, and then it would slowly start to fade against their positions. I've seen this happen day in and day out. But if you look right here, you can kind of see some of that buy side absorption right around that 49 offer, and everything above that 50 offer are considered pretty much unfair highs. So again, now the market going for another low at this point. So the market does end up going for a new low as it was slowly rotating down, holding this 43 area on the offer. We saw a move all the way down to 336, bottomed at 333, and then sooner or later it was on a rally. Now if you look at this move right here, look at how quickly it rallied off of the lows. So look at the speed and the velocity of this move right here. After we took out that low, rebid 36, buyers answered right away, right off of the lows. We saw strong buyers initiate, and then the market is starting to rotate its way back up. Now it's not giving traders a chance to get in on any kind of pullback. It's just going straight up. Now by the time traders see the move has taken place, guess where it is? Right back to 49, the area where all these buy absorption have taken place. So again, this area is still resistance contextually, and the way it approached it here still indicates that if you buy it here, you're really buying the high of this range. And this is something that can trick a lot of traders into getting into positions, right? They see this and they say auction market theory. Okay, it tested the low, now it's testing the high. I'm gonna buy because it's going to 58. But what you don't realize is that this area is still considered unfair highs, and in order for this area to get tested, you truly need enough sell side liquidity that's getting trapped that could initiate as buy stops in this area. And again, just one way of seeing it, but that's something that I was able to identify from this pattern right here that indicated to me that buying at 49 was not a very good idea in this case. And again, there's lots of these little nuances that play out through the day, and I guess you get used to looking at them as the day goes by. So guys, if you found this video educational, please leave a like on the channel, and I will catch you in the next one. Take care, bye.